Hey everybody, it's Robschild. It's Friday, July 18th, 2025. Our episode today begins with our headline 27-year record low credit spread equals peak complacency. But don't take it from me, take it from the Fred website themselves, their chart of the ICE Bank of America AA U.S. Corporate Index Option Adjusted Spread. Now, in really crazy times, AA bonds, even AA bonds can have a spread of almost 5%. As you've seen on many of my shows, junk bond credit spreads can get up to 20%. These will typically be, between 0.5% and 1%. Occasionally when things are getting frothy, up towards 2%. But right now, as it stands, July of 2025, we're at 0.44, and I just find it very notable that we have not been this tight in double A credit bonds since 1997, showing a 27-year record low. Now, while I can agree AA corporate bonds have very low risk, they don't have zero risk. And when we hit a record low like this, in something like this, my ears perk up and I'm starting to wonder, hey, maybe there is a little bit more risk here than what the market believes. It also is a tribute to how much demand there is for debt instruments in general, if you think about it. A spread this tight simply means more than anything that there's very high demand for AA bonds right now. As a Benjamin Graham value investor, I'm very interested in corporate debt when it gets very cheap, and right now it's as expensive as it can get. Next headline for today, crypto. If it's in the press, it's in the price. The press that I'm referring to came out towards the end of the trading day today, actually. Trump signs Genius Act, delivering milestone law to crypto industry. And using a little bit of ChatGPT, to summarize, it's regulating crypto stablecoins, so coins that are issued that are backed by something. They're saying, hey guys, you actually have to have the stuff that you're saying you have backing your digital currency, along with some other rules. And, great milestone for crypto, right? Well, not so much according to the price. Bitcoin dropping on this news, along with all of the other cryptocurrencies combined, total too, you can find this chart on TradingView, also dropped, forming what looks to be like maybe a doji, probably more of a topping tail, which is an extremely bearish looking signal actually. Oh, sorry, you can't see it. There it is. The topping tail. I don't know if you saw the Bitcoin one either. Let's go back to that one. Sorry, my technology. I'm dealing with limited technology right now. Things will get back to normal, I think next week. Most chartists agree Bitcoin is bearish right now because of on the daily time frame. Another thing that I wanted to share and take a look at with you is the weekly, only because this longer trend line that you probably know about if you've been watching my show or other people's shows, that goes from the 2017 high to the 21-22 highs, connecting to the 24 highs, breaching above it. So on the weekly candle, what we want to see is Sunday night. If we can close above the high of this weekly candle, which would be 119,482. If Sunday night closes above that, that's actually very bullish on a much longer time frame for Bitcoin, and that's when I will be unfortunately selling my short at a loss if that occurs. As it stands, it looks bearish to me. I suspect we will drop below this orange line sooner than later, but just a crystal ball reading. Another way to see this news as, by the rumor, so crypto goes up on the rumor that these regulations are going to pass, and sell the news, and then it got sold. So we'll see how things continue from here. Anyway, moving on to our next headline. PPI came out cool this week, actually completely flat month over month. And I want to add some commentary to that. This whole idea of Powell and everyone being afraid of further or worse inflation, and then you see numbers month over month and PPI going completely flat. It's almost worrisome at this point that there isn't more inflation off of these tariffs. Tariffs are supposed to be inflationary, and to not see them just shows me how weak things really are. And like Waller, you probably saw in some headlines ringing the alarm bell on things saying, hey, we need a cut in July, actually. The combination of complacency and weakness is not a good one in my book. We'll see how it all plays out. We also had initial jobless claims actually come in much lower than expected, but we still have continued claims staying elevated, but not reaching new highs yet, according to this last report. Moving on to the community topics. What moves, if any, did you make today? Comment in the section below. Robschild has his finger on the trigger with a few things. We'll talk about that momentarily, but I did sit on my hands today. Comment below what you did. Coming up, we have, as always, more tariff updates, and one actually that just came out is that we're pushing now for 15 to 20% minimum tariff goods on European goods. Again, I find it hilarious that every time the stock market goes up, Trump comes out with like, hey, we're going to give tariffs to these guys. Hey, you can't do that. We're going to do tariffs to these. And then the market, he pushes and pushes until the market starts cracking. Then he says, oh, no, hey, we got a good deal going on. And the market goes up. Trump controls the stock market right now, all by himself. It's incredible to watch this. And we can definitely expect that to continue. There's not really much any economic data coming out next week besides the weekly jobless claims, so we'll see how things go. We'll get to the charts in a moment. Thank you for watching, subscribing, commenting, and supporting. I'm very close to 1,000 subscribers. I hit 1,000 and then backed off. I got a spam bot attack thing. But we're almost there, guys, in the Robschild community. Thank you so much for your support. No changes to the daily reminders macro views. Read my website in the description to go through them. I think they're very important to know about. The crystal ball ratings in the Robschild portfolio, no major changes. The thing I have my finger on the trigger for is REMX. That's been going way up, and the trailing 12-month PE ratio is like 25 right now. But a lot of its holdings are still very low. But anyway, we'll talk about that more when we get to that chart. Alright, on to the chart, starting with the SPX, the S&P 500, closing basically at the all-time high that we had an all-time high close on Thursday, and went a little bit up and closed basically right on it today. Today was options expiry today, so institutions kind of need things to stabilize on a day like today and then let things go wherever they're going to go on Monday. TLT, my favorite place to be. I haven't done a show in a few days. On Wednesday, Trump announced, hey, I'm going to fire Powell again, and then the Treasury market's like, oh, no, you're not, or we're going to sell off, we're going to sell all of our Treasuries. It plummeted till the second he retracted it, and then the Treasury market bounced right back up. I don't really know exactly where this is going, but I find it notable that the MOVE index is relatively very low compared to what we've seen in the past, suggesting that the markets are expecting there to be more calmness in the bond market more than anything for now, not expecting them to sell off or go to the moon. Next, TNX, the 10-year Treasury note yield. I just wanted to bring up this inverse head and shoulders that, bulls on yields have been talking about it, going higher. We did cross the line, but we didn't get a confirmation close above the break line. And actually we closed essentially right on the line today. So yields are flat, and I see this head and shoulders pattern largely as being sort of negated already. I'll leave it there for now. But anyway, moving on, we're going to take a look at HYG divided by SHI to see where credit spreads are going. And of course, alongside corporate bonds getting to 27-year record tightness, we have junk bond credit spreads also tightening a bit today, only just below 3%. It's not as complacent actually as the AA bond market seems to be right now, but still very, very tight, very, very tight. So still very complacent, I'll say. Next, I want to bring up TIP divided by IEF, which represents day to day where inflation expectations go. Michigan Consumer Sentiment Report came out expecting inflation lower than what was predicted. They were predicting, people thought it would be something like 4.9%, and now it's like under 4%. And so that news helped the TIPS market get a bid and the inflation expectations to drop a little bit today. Again, we'll see where they will go from here. We have been sort of spiking up in inflation expectations, not to get to like extreme highs, but it has been a formidable ride to the upside. Might as well show that chart directly. This is the 10-year break-even inflation rate. When I scroll in, it does show today's. Oh, it's okay. No, it's past 5. Okay, thought it was still before 5. Anyway, so yeah, so they cooled back off a little bit, but yeah, when we scroll out to a 5-year history, we're on the upper end of where we've been over the past few years. So if this continues to trend higher, the Fed's not going to be able to cut. They're going to have to... Sorry, it looked like I froze there. Again, the technology thing. We'll get back to it. Point is, the 10-year break-even inflation rate, we're at the top of where we've been for the past few years. So if this accelerates to the upside, I don't see how the Fed can cut actually in July or September or any month until this starts rolling to the downside. As Powell has said very explicitly, how can we have stable employment if we don't have stable prices? So it's very clear to me. I'm the only voice that I hear saying this. Everyone else seems to think that the Fed is going to support the jobs market more than I think they are. And it's because of including that statement in every single press conference for the past, at least year. He has said explicitly, in order to have stable employment, we need stable prices, and we watch the 10-year break-even inflation rate. And I'll say it again. I said it before, I'll say it again. When it was dropping down to 2, they got fearful that it would go below 2. That's why they had the cuts. Whether politics were involved, whether any other data was involved, I don't know, but I do know that this chart told them they needed to cut, and that's the primary reason I think they did. And it's the primary chart that will prevent them from hiking or cutting in the future. If you want to see what the Fed's going to do, first, this is the chart to look at first, the 10-year break-even inflation rate. Alright, moving on. I see my screen, I think, is covering some of the charts sometimes. Sorry about that if there's anything missing. So, next chart is oil. We've been consolidating at this bottom area here, and today we had sort of an engulfing candle the last 3 days, all within sort of a bear flag formation still. So, I believe, and a lot of other traders believe, oil is actually... from just the chart alone, about to start cracking to the downside. We'll see what happens. I found it really notable. Copper has been really winding up in this sort of perfect looking flag thing for a while. Let's see if I can get this to work. I'm going to reload it. Again, sorry about the technology difficulties here. I saw this as just this curved flag thing that had been developing, and we broke to the upside today. Is it a fake out or a breakout? right now it looks very bullish, although it's a very small green candle for breaking out of such a tight consolidation, which gives me a little bit of hesitance to believe that it is set to continue much higher, but we'll see. So this is a very important commodity to always be very mindful of. I wanted to bring up gold today as well, because gold has just been getting really tight, just chop, 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 sideways, sideways. Are we headed up to the moon, or are we headed down? My take on it, I've said this before and I'll say it again, when you have the price of gold and you relate it to silver, to copper, to housing, to the M2 money supply, to anything, it's historically extremely, extremely expensive right now. And so I personally expect gold actually to break to the downside. But I know there's a lot of gold bulls out there that have been proven to be right. We'll see how much longer the music plays on that one. Next chart, KWEB, Chinese ETF. Part of the reason it was able to break out of this consolidation to the upside has to do with America can now sell them chips that they couldn't get before. So now that they have access to better technology, I think that gave a bit of a boost to Chinese equities. And I'm going to be looking to potentially start selling when we get up to the 12 trailing month PE ratio of about 20, which is around 37.73 in price. As a value investor, this is what I do. I buy stuff that seems too cheap and I sell it when it becomes normal. But one thing that worries me a little bit is, with markets being this complacent, if we do get Mr. Market waking up to the fact that so much is so overvalued, Chinese equities won't be spared in the downfall. When you get really big cracks to the downside in markets, Chinese equities oftentimes are a part of that. Last chart of the day, REMX. If you have been a fan of me and my show, you know that this is one of my largest holdings. I've been holding 5 or 6% of my portfolio in this as sort of, I always like to have a little bit of exposure to some kind of metals, and I buy stuff that I think is the cheapest, and I think rare earths have been the cheapest for a very long time, actually now. They're underperforming silver, copper, gold, everything. So now all of a sudden, part of the reason REMX rare earths are going up is worries over China basically using the fact that they have so much production of these metals. If they decide to shut off their supply because they get mad about all this tariff stuff, that can make REMX soar the way it did decades ago, when this very fund was in the hundreds of dollars, and 20 years later getting down to $30 is kind of funny. Anyhow, my finger is itchy on this, but the other thing is I like to be invested in some kind of metal all the time, and so seeing as though I think silver is a bit expensive, gold is insanely expensive right now, so I can't buy that. That's not cheap. That's not what I do. I buy cheap. I buy what seems cheap. And even copper is elevated, to say the least. The fact that the other rare earths have a lot of catching up to do tell me that this is still the best place for me, for my money, when I'm thinking about having any kind of metals exposure. So that's it for today's show. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.